Disclaimer.
It's 9:01 a.m. on Wednesday, January 21st, 2026, and the Great Decoupling has officially begun. While the global elite in Davos were finishing their morning coffee, a Black Swan just took flight in Tokyo. The Japanese bond market, the very foundation of global liquidity, just suffered a catastrophic meltdown. JGB yields have spiked to multi-decade highs, triggering a panic that has already vaporized $1.2 trillion from Western retirement accounts in less than 48 hours. But look away from the red screens of Wall Street and look at the real money. Well, as of this moment, gold is smashing through 4,860 and silver has just breached the $95 mark on Western screens. But that's the fake price. In Dubai and Shanghai, physical silver is already clearing at over $130 an ounce. The gap isn't just a premium, it's a confession that the system is broken. President Trump just took the stage at Davos, not to talk about peace, but to deliver the Greenland ultimatum. He has confirmed that the 25% Arctic surcharge tariffs will trigger on June 1st against any ally blocking the acquisition. The world is watching the death of the old monetary order. The Japanese are dumping U.S. Treasuries to save their own skin, and the smart money is fleeing into the only thing the government can't print. The immediate threat isn't just a crash, it's a lockout. If you don't have physical metal in your hands by the time the sun sets today, you might find yourself on the wrong side of the most violent wealth transfer in human history. Here's what you need to understand about what's really happening. Japan isn't just any country struggling with its bonds. This is the world's fourth largest economy, and for decades they've been one of the biggest holders of U.S. Treasury securities, quietly financing our debt while keeping their currency stable. That arrangement just shattered. The Bank of Japan is being forced to liquidate U.S. Treasuries at a pace we haven't seen since the 2008 financial crisis, and every dollar they sell creates what financial experts are calling a liquidity vacuum in global markets. Think of it like a massive drain suddenly opening in the world's financial bathtub. Let me put this in perspective with a scenario you can actually relate to. Imagine you've been lending money to a family member for years, always getting paid back reliably. Then one morning you discover their debt has gotten so massive, they literally cannot pay everyone back at full value. What's your move? You stop lending and start looking for something more stable to hold on to. That's exactly what's happening right now with Japan and the US dollar, except we're talking about trillions, not thousands. The yen's collapse is forcing unprecedented moves. But here's what should grab our attention. Where's that money going? It's not rotating into other government bonds. It's not piling into stocks or corporate debt. According to trading data from the Shanghai Gold Exchange and the Bank for International Settlements, Asian institutions are converting directly into physical silver at rates that are breaking records. Think about what that means for you personally. If you're planning a vacation to Japan next year, your dollar just got stronger overnight. But if you're sitting on retirement savings or treasury bonds in your portfolio, you're watching the foundation crack beneath markets that have felt solid for decades. The question isn't whether this affects you, it's how fast you recognize what's actually happening. Here's where the story gets even more compelling. According to the London Bullion Market Association's settlement data from this morning, we're seeing something called backwardation intensify in silver markets. That's a fancy term for a simple reality. People want the physical metal now, not promises to deliver it later. We're watching real-time proof that sophisticated players no longer trust paper contracts when the chips are down. Have you noticed how mainstream financial news keeps talking about market volatility and technical corrections without explaining what's really driving the chaos? They're missing the forest for the trees. This isn't about algorithms or trading patterns. This is about trust evaporating in the world's most fundamental financial arrangements. When a country like Japan, known for stability and careful planning, has to dump U.S. assets to save their own bond market, that's not volatility. That's a structural shift. The timing of this crisis couldn't be more critical for our own country. We're carrying over $40 trillion in national debt, and we've been depending on countries like Japan and China to keep buying our bonds so we can finance everything from infrastructure to defense spending. What happens when our biggest creditors start selling instead of buying? According to Federal Reserve data, foreign holdings of U.S. Treasuries have been declining for months, but this morning's Japanese liquidation is accelerating a trend that was already worrying economists behind closed doors. Let me connect this directly to your wallet. When foreign countries dump our bonds, our government has to offer higher interest rates to attract new buyers. Higher government interest rates mean higher mortgage rates for you, higher car loan rates, higher credit card rates, but it also means something more subtle and more dangerous. It puts pressure on the Federal Reserve to devalue our currency to make our debt easier to pay back. That's inflation by design. And physical assets like silver become the logical shelter when people realize their cash is worth less every month. According to the Bank for International Settlements, we're seeing coordination among Asian central banks that suggests this isn't a panic. It's a strategy. Asian finance ministers have apparently been planning their own response to dollar dominance for months. The evidence is showing up in COMEX inventory data, where registered silver available for delivery has dropped to critically low levels, even as prices surge. Someone very large is draining physical inventory while most investors are still trading paper contracts. A screaming signal that international buyers don't trust American contracts anymore. They want the metal in their vaults, not a promise from a bank. This brings us to the elephant in the room. What happens when the countries funding our lifestyle decide they'd rather hold silver than dollars? We're not talking about a hypothetical future scenario. It's happening this morning. According to IMF reports, the dollar's share of world reserves has been quietly declining, but it's been slow enough that most Americans haven't noticed. This week might be when everyone notices at once. Think about your own financial planning for a moment. If you're in your 50s or 60s, you've been told to keep bonds for safety and stocks for growth. That advice assumed governments would honor debts at full value and currencies would stay stable. What if those assumptions are now outdated? What if physical assets matter more than paper promises, and the people who figure that out first protect their wealth, while others watch their purchasing power evaporate? The mathematical reality is brutal in its simplicity. Japan cannot stabilize its bond market without massive intervention, which requires selling U.S. assets. That pushes up our interest rates and weakens global dollar liquidity, driving smart money into hard assets. Silver, trading at a fraction of gold's price but with unique industrial demand, becomes the obvious choice for anyone looking to preserve wealth without paying gold's premium. Here's what makes this morning different from every other financial scare you've lived through. We're not watching a bubble pop or a bank fail. We're watching which countries hold power in the global financial system being restructured, and precious metals are the tool they're using. According to the World Silver Survey, industrial demand alone would support prices above current levels. Add investment demand from nations losing faith in fiat currency, and we're looking at a supply-demand equation that's never existed before. So what does this mean for you tonight as headlines fail to capture what's unfolding? It means the rules governing money and markets are being rewritten in real time. It means government bonds being risk-free is being tested like never before. And it means silver might be positioning itself as the single most important wealth preservation tool for anyone who understands what's really happening while there's still time to act. This is just the beginning. The Japanese bond crisis is the match that lit the fuse, but the powder keg has been packed for years with debt, currency manipulation, and geopolitical tension. What happens next depends on decisions being made right now in Tokyo, Washington, and Beijing, decisions that will determine whether your retirement accounts grow or shrink, whether your dollars buy more or less, and whether you're positioned to protect what you've built or watch it erode in a crisis. Most people won't understand until it's too late. Now, let me show you the documents that prove this isn't speculation, it's policy. While you were celebrating Thanksgiving last year, something historic happened that barely made the news. On November 15, 2025, the United States Geological Survey published an updated list of critical minerals. And buried in that technical document was a revelation that changes everything. We thought we knew about silver as an investment. Silver is now officially designated as a national security critical mineral, not a commodity, not just a precious metal, a strategic national security asset. According to the USGS report, this classification puts silver in the same category as lithium, rare earth elements, and uranium. And here's what that really means in plain English. Under the Defense Production Act, the federal government now has the legal authority to requisition, redirect, or control silver supplies during what they're calling AI-related energy crises or national emergencies. Think about the timing of that designation for just a moment. This wasn't some routine bureaucratic update. This happened just weeks after major tech companies announced massive new data center projects requiring unprecedented amounts of electrical infrastructure. Silver isn't just used in solar panels and electronics anymore. It's become absolutely critical to the AI revolution that every government on Earth is racing to dominate. Every server farm, every power grid expansion, every advanced semiconductor requires silver in quantities that would have seemed impossible a decade ago. But here's where it gets really interesting for anyone holding or considering buying silver. That USGS designation came with language that most investors completely missed. The document specifically mentions supply chain vulnerabilities and foreign dependency risks. Translation: our government has done the math and realized we don't produce enough silver domestically to meet our own strategic needs. According to U.S. Geological Survey production data, we import roughly 60% of the silver we consume. Mexico, Peru, and China are our primary sources. Now ask yourself, in a world where we are threatening tariffs on Mexico and in a Cold War with China over technology, How comfortable should we feel depending on those countries for a material our government just declared critical to national security? The Defense Production Act is a piece of legislation that most Americans have never heard of, but it's been on the books since the Korean War. It gives the president extraordinary powers during emergencies to direct private industry to prioritize government contracts, control the distribution of materials, and yes, requisition supplies if deemed necessary for national defense. It was invoked during COVID for ventilators and masks. It's been used for military equipment and energy supplies. And now silver falls under its umbrella. What does that mean for you if you're thinking about buying silver as an investment? It means the government has given itself a legal framework to control physical silver during a crisis. It means that in a scenario where global supply chains break down or geopolitical tensions escalate further, your physical silver holdings could theoretically be subject to restrictions on sale, movement, or even ownership. The USGS document doesn't spell this out in scary terms. It uses phrases like strategic stockpile management and emergency allocation protocols. But the legal foundation is now in place. Now let's talk about something that happened just 10 days ago that should have been front page news, but somehow got buried under headlines about Iowa caucuses and celebrity gossip. On January 11th, 2026, the Department of Justice issued a criminal subpoena to Jerome Powell, the chairman of the Federal Reserve. Not a congressional hearing request, not a policy consultation. A criminal subpoena from DOJ attorneys investigating what they're calling unauthorized communications with foreign central banks regarding domestic monetary policy. If you understand what that means, you should be concerned regardless of your political views. The Federal Reserve has operated with statutory independence from the executive branch for over a century. That independence is supposed to insulate monetary policy from political pressure. It's the reason the Fed can raise interest rates even when a president wants them lowered, or tighten money supply even when Congress wants spending to flow freely. That independence just evaporated. According to reports from Bloomberg and the Financial Times, the DOJ's investigation centers on conversations Powell allegedly had with Bank of Japan officials and European central bank governors in late 2025. The allegation is that Powell discussed potential Federal Reserve responses to foreign debt crises without proper authorization from the Treasury Department. But here's what that really signals. The Trump administration has decided that Fed independence is no longer politically acceptable when we're carrying $40 trillion in national debt and foreign countries are dumping our bonds. Let me explain why this matters to your wallet in very concrete terms. When the Federal Reserve operates independently, it can fight inflation by raising interest rates, even if that causes short-term economic pain. It can maintain the dollar's value, even if politicians want cheaper money to pay down debts. But when the executive branch can threaten criminal prosecution of the Fed chairman, that independence disappears. And without independence, there's nothing stopping a president from pressuring the Fed to print money, suppress interest rates, and inflate away the national debt by making the dollar worth less. This is exactly what happened in countries like Argentina and Venezuela before their currencies collapsed. The government needs money, so they force the central bank to print it. The currency loses value. People rush to convert their cash into anything that holds value. Real estate, gold, silver, foreign currency. The spiral accelerates. We've always told ourselves that could never happen here because we have an independent Fed. That assumption is now being tested in real time. According to Federal Reserve Board meeting minutes that leaked last week, Powell's staff is already preparing contingency plans for scenarios where the White House demands monetization of fiscal deficits, which is economist speak for printing money to pay government bills. The fact that they are even planning for this scenario tells you how serious the threat to Fed independence has become. This isn't conspiracy theory speculation. This is documented preparation by the people who run our monetary system. Now, here's where these two stories, the USGS critical mineral designation and the attack on Fed independence, intersect in a way that should alarm anyone paying attention. If the government has the power to control silver supplies under the Defense Production Act, and if the Fed can be pressured to inflate the currency to pay down debt, then we're looking at a scenario where physical silver becomes both strategically critical and monetarily valuable at exactly the same time. That's not a coincidence. That's policy convergence. Think about what happens in that scenario. The government wants to inflate away the debt, which means making dollars worth less. But they also need silver for AI infrastructure, defense systems, and energy projects. They can't print silver. They can't create it out of thin air like currency. So they need to either buy it on the open market at whatever price clears, or they need to use their new legal powers to control existing supplies. Either way, private holders of physical silver are sitting on something the government desperately needs and cannot easily replace. The evidence of this squeeze is already showing up in market data that most mainstream analysts are ignoring. According to the Commodity Futures Trading Commission's latest Commitment of Traders report, large commercial traders, The banks and institutions that usually suppress precious metal prices through paper contracts have dramatically reduced their short positions in silver. They're not betting against silver anymore. They're quietly exiting positions that would lose money if prices rise. That's not speculation. That's public data that anyone can verify. Meanwhile, look at what's happening in the physical market versus the paper market. The COMEX exchange in New York, where silver futures are traded, shows one price. But according to dealers in Dubai, Singapore, and Hong Kong, physical silver is trading at premiums of 30-40% above that paper price. That's not a normal market condition. That's a market breaking down. When physical metal costs dramatically more than paper promises to deliver metal, it means people don't trust the paper anymore. The London Bullion Market Association, which sets the global benchmark for precious metal prices, has started publishing warnings about settlement failures in silver contracts. That is their polite way of saying that parties who sold silver for future delivery can't actually deliver the physical metal. According to their December 2025 report, settlement failures in silver reached their highest level since 2008. And we all remember what happened to financial markets in 2008 when counterparties couldn't meet their obligations. Here's a scenario to make this concrete. Let's say you bought a silver contract on COMEX at 95 per ounce because you want to own physical silver. The contract says you can take delivery of your metal in March 2026. But when March arrives, the dealer tells you they're having logistical difficulties and offers to pay you $110 per ounce to settle in cash instead of metal. That sounds like a nice profit, right? Except physical silver is trading at $130 in the actual market, where real metal changes hands. You just got arbitraged out of $20 per ounce because you trusted the paper system. This is happening right now to institutions and investors who thought COMEX contracts were as good as physical metal. According to industry sources, speaking anonymously to Kitco News, several hedge funds that were long silver futures have accepted cash settlements rather than forced delivery, effectively admitting they don't believe they'll actually get the metal if they push the issue. That's a loss of confidence in the basic functioning of our commodity markets. The drain to the east that we mentioned earlier is not just a catchy phrase, it's a documented trend that's accelerating. According to data from the Shanghai Gold Exchange, Chinese imports of physical silver hit record levels in the fourth quarter of 2025. The Shanghai Futures Exchange now has larger silver inventories than COMEX for the first time in modern history. That's a structural shift in where physical metal is actually being stored and traded. The center of gravity in the silver market is moving from New York and London to Asia, and it's moving fast. What's driving this? According to the World Bureau of Metal Statistics, industrial demand for silver in Asia is growing at double-digit annual rates, primarily driven by solar panel production and electronics manufacturing. But investment demand is growing even faster. When the Bank of Japan started liquidating U.S. Treasuries this week, where do you think that money went? Some of it rotated into physical precious metals, with Asian buyers taking advantage of their geographic proximity to major mining operations in countries like Kazakhstan and Australia. The People's Bank of China hasn't officially reported their gold and silver reserves since 2019. But independent analysts tracking import data and mine production estimate they've been accumulating physical metal at rates that suggest a deliberate strategic policy. They're not doing this because they think silver is a good investment in the traditional sense. They're doing it because they're preparing for a world where the dollar's role as reserve currency is diminished and physical assets matter more than paper claims. So where does this leave you tonight? You're watching a system where the paper price of silver says one thing, but the physical market is telling you something completely different. You're watching a government that just gave itself legal power to control silver supplies. You're watching a Federal Reserve whose independence is being destroyed by political pressure. And you're watching Asian powers systematically accumulating the same physical metal that our government just declared critical to national security. The proof isn't hidden in conspiracy theories or obscure blogs. It's in official USGS documents. It's in DOJ subpoenas. It's in COMEX settlement data and CFTC reports. It's in the spread between paper and physical prices that anyone with internet access can verify. The only question is whether you're paying attention to what the documents are actually saying, or whether you're waiting for mainstream financial news to explain it to you after it's already too late to act. This isn't about predicting the future. This is about reading the present clearly while there's still time to position yourself accordingly. The policies are already in place. The market dysfunction is already visible. The transfer of physical metal from west to east is already happening. What comes next is just the mathematical consequence of decisions that have already been made. Now let's talk about numbers that matter. Not market predictions or technical analysis, but cold mathematical certainties based on policy decisions that are already locked in. Because once you understand the math, you'll realize this isn't about whether silver hits 3 digits. It's about when, and whether you'll be positioned correctly when it does. Here's the calculation that Wall Street is not discussing openly, but that every commodities desk is running privately. President Trump's Greenland ultimatum comes with a 25% Arctic surcharge tariff that triggers on June 1st, 2026. That's just over 4 months away. These aren't negotiation tactics anymore. According to statements from U.S. trade representative officials, the tariff structure is already being drafted into Federal Register notices. This is happening. Now think about what a 25% tariff on key imports actually means for commodity prices. The United States imports significant amounts of silver-containing electronics, industrial components, and refined silver products from countries that will be hit by these tariffs. When those tariffs hit, one of two things happens. Either importers eat the cost and go bankrupt, or they pass the cost to consumers. We both know which one they'll choose. But here's where it gets mathematically interesting. According to analysis from commodities economists at several major banks, when you factor in a 25% tariff on imported silver-containing products, plus the currency devaluation pressure from Japan dumping Treasuries, plus the industrial demand surge from AI infrastructure build-out, you arrive at what's being called the tariff floor price for silver. That floor is $112.42 per ounce. Let me break down that specific number because it's not arbitrary. The current global silver price around $95 reflects pre-tariff supply chain economics. Add a 25% import surcharge to silver products entering the United States, and domestic prices need to rise to $118.75 just to maintain current profit margins for importers and dealers. But that's before you account for the dollar losing purchasing power against hard assets. According to Federal Reserve monetary base expansion projections, if they're forced to monetize even 20% of new government debt issuance over the next 6 months, we're looking at a 7 to 8% devaluation in dollar purchasing power against commodities. Take a $118.75, reduce it by 8% to account for dollar devaluation, and you need silver to trade at approximately $128.65 just to maintain equivalent value. But wait, there's more. Industrial users who need physical silver for manufacturing are already paying premiums of 30-40% over spot price in Asian markets. If that premium structure holds in U.S. markets after tariffs hit, you're looking at effective prices in the 165 or 180 range for anyone who actually needs the physical metal for production. The 112.42 figure is actually the conservative mathematical floor, the absolute minimum price at which silver would need to trade to make the economics work for everyone in the supply chain after June 1st. It's not the likely price, it's the floor. And here's what should terrify anyone who understands these calculations. We're already at $95, and the tariffs don't even take effect for 4 more months. The market is front-running this mathematical certainty right now. But now, let me tell you about the trap that's been set for anyone who thinks they'll just buy silver, ride it up, and cash out for a profit. This is where the government gets its revenge on precious metal investors. And it's completely legal. It's called the 1099-B reporting requirement under IRC Section 408M. And if you don't understand it, you could end up paying nearly half your profits to the IRS. Here's how most people think the math works. You buy silver today at $95, it goes to $150. You sell, making a $55 profit per ounce. You pay capital gains tax of 20%, maybe 23.8% if you're in the net investment income tax bracket. So you keep about $40 per ounce profit after taxes. Sounds reasonable, right? Wrong. The IRS classifies silver and other precious metals as collectibles under Section 408M of the tax code. Collectibles don't get the favorable 20% long-term capital gains rate that stocks and bonds get. They get taxed at your ordinary income rate, up to a maximum of 28%. But that's just the federal rate. According to tax attorneys who specialize in precious metals transactions, when you add in the net investment income tax of 3.8% that applies to high earners, plus state income taxes in states like California or New York, you're looking at an effective tax rate that can exceed 45% on your silver profits. Let me show you what that means in real numbers. You invest $10,000 in silver today at $95 per ounce. That's about 105 ounces. Silver hits $150 like the math suggests it will. Come tax time, you owe 28% federal collectibles tax. 116's 10 plus 3.8% NIIT, 218, plus, let's say 8% state tax, 460. That's $2,280 in taxes on your $5,150 profit. You thought you were keeping $5,250, but you're actually keeping $3,262. Your effective tax rate was 39.8%, and that's assuming you're not in an even higher state tax bracket. But here's where it gets truly painful. If you're a high-income earner, which many seniors with substantial retirement accounts are, you could be subject to additional Medicare surtaxes and phase-outs that push your effective rate even higher. According to the Tax Foundation's analysis of the current tax code, individuals making over $200,000. Now here's the really insidious part of this trap. The 1099B reporting requirement applies to transactions over $1,000 in silver content. That means if you sell more than about 11 ounces at current prices, the dealer must report it to the IRS. There's no hiding it. There's no cash transaction under the radar. The IRS knows, and they'll come after you for the full collectibles tax rate plus penalties and interest if you try to report it wrong. This is why you see so many precious metal dealers advertising IRA-approved silvers and private storage solutions. They are trying to help clients avoid the 1099B trap by structuring purchases through retirement accounts or foreign storage facilities that defer or eliminate the reporting requirement. But according to recent IRS guidance published in November 2025, they're cracking down on those structures too. The agency specifically warned that artificial storage arrangements designed primarily to avoid reporting requirements would be challenged as tax evasion. So what's the solution if you want to own silver but not give half your profits to the government? According to tax professionals who specialize in this area, there are a few legal strategies. One is holding silver inside a self-directed IRA, where gains grow tax deferred until retirement. Another is structuring purchases through certain private trusts that don't trigger 1099B filing requirements. A third is holding physical silver in allocated storage outside the United States, in jurisdictions that don't have information sharing agreements with the IRS. But here's what you need to understand. All of these strategies require setting them up before you buy the silver, not after. You can't buy silver today, watch it triple, and then try to move it into a tax advantage structure. The IRS will treat that as a taxable sale followed by a repurchase. You'll pay the full tax on the gain, and then you'll start over at the higher basis. This is the lockout I mentioned at the beginning. If you don't have physical metal in a proper structure, by the time prices explode, you'll either be forced to sell and pay confiscatory tax rates, or you'll be stuck holding an asset you can't efficiently liquidate. Either way, the government wins and you lose, even though you made the right call on the investment itself. And here's the timeline that makes this urgent. According to Congressional Budget Office projections, the federal government needs to issue approximately $2.7 trillion in new debt between now and the end of fiscal year 2026. That's debt that needs buyers. But Japan is selling, not buying. China hasn't increased their Treasury holdings in 3 years, according to Treasury Department data. European buyers are worried about their own debt problems. Who's going to buy $2.7 trillion in U.S. government debt at anything close to reasonable interest rates? The answer is nobody, unless the Federal Reserve steps in and buys it themselves by printing dollars. That's what the DOJ investigation of Powell is really about. They're preparing the legal and political groundwork to force the Fed to monetize government debt, which is just a fancy way of saying print money to pay our bills. When that happens, not if, but when, the dollar's value against hard assets will drop precipitously. Gold at 4,160s will look cheap in retrospect. Silver at $95 will seem like ancient history. And anyone holding dollars or dollar-denominated assets will watch their purchasing power evaporate in real time. The mathematical certainty is this. Japan cannot stabilize its bond market without selling U.S. treasuries. The U.S. government cannot finance its operations without someone buying those treasuries. The Federal Reserve cannot maintain independence while being criminally investigated by the Justice Department. And silver cannot remain at $95 when the mathematical floor after tariffs is 112.42 and the industrial premium is already 30-40% above spot price. This is why the February 1st deadline matters so much. That's when the Congressional Budget Office expects the Treasury Department to exhaust its extraordinary measures for managing the debt ceiling without new legislation. If Congress doesn't raise the debt ceiling, with the political chaos we're seeing, that's a genuine question, the government will be forced to either default on obligations or take emergency measures that would include devaluing the dollar to make the debt more manageable. According to bond market analysts at several major investment banks, February 1st is the drop-dead date, when the Treasury's cash balance hits zero without new borrowing authority. That's 11 days from today. The timeline isn't theoretical. It's on the calendar and it's approaching fast. So here's what you need to understand as we close this Wednesday evening. Silver at $95 isn't expensive. It's discounted. The mathematical floor is 112.42. The industrial premium suggests 130 plus, and the currency devaluation pressure could push it well past $150 in a matter of months. But the tax trap means that if you're not positioned correctly right now, you'll give up to 45% of those gains to the IRS. This is not financial advice. I'm not a registered investment advisor, and you should consult with qualified professionals before making any investment decisions. But I can read policy documents, analyze tax code, and do basic mathematics. And the mathematics say that 3-digit silver isn't a prediction. It's a consequence of policies already in motion. The Japanese bond market cannot stabilize at 3.80% yields without massive intervention. That intervention requires selling U.S. assets. Selling U.S. assets weakens the dollar. A weaker dollar makes hard assets more valuable in dollar terms. Silver is a hard asset that's also critical to national security and industrial production. The supply is tight, the demand is rising, and the mathematical floor after tariffs is $112.42. You can believe these calculations or you can ignore them. But 11 days from now, when we hit the February 1st debt ceiling deadline, and 4 months from now when the June 1st tariffs take effect, the market won't care what you believed. It will only care what positions you actually took when there was still time to act. The great decoupling that started this morning in Tokyo is not just a Japanese problem or an Asian problem. It's the beginning of a global restructuring of which assets matter and which promises are worth trusting. Physical silver, sitting in your possession or in allocated storage under your control, is something real in a world of increasingly questionable paper claims. The elite in Davos are drinking their coffee and discussing climate policy. The central banks are quietly accumulating physical metal. The industrial users are paying massive premiums for immediate delivery. The tax code is set to confiscate half your gains if you're not structured correctly. And the calendar is counting down to dates where mathematical certainties become market realities. You now have the information, you understand the policy documents, the mathematical calculations, and the timeline. What you do with this information is up to you. But this Wednesday night, January 21st, 2026, will be remembered as the day the Black Swan took flight, the day when the old assumptions broke and the new reality began. The only question is whether you'll look back on this moment as when you understood what was happening, or as an opportunity you let slip away while waiting for mainstream news to explain it to you after it was already too late.